All information contained in this podcast is general in nature and does not consider your individual circumstances. You should consider the appropriateness of this information with regards to your individual objectives, financial situation, and needs. Welcome to Sharing More Than the Sheets, a podcast to help you and your partner make better financial and lifestyle decisions so that you can both focus on the things that you love. I'm your host, Michael Khouri, financial planner, green thumb, husband, and just dad. Self-managed super funds. Setting up a super fund and using it to buy an asset, for example, a house. In the last 5-10 years, these have become very popular. And I've had a lot of clients approach me about setting up an account, setting up a super fund and using it to buy an asset like a house, because to many it's appealing, having their super in something that they can touch and feel. But today we're discussing the ins and outs of a self-managed super fund and how they work, some of the pitfalls, some of the advantages, and I guess a few strategies where a self-managed super fund can come in handy. With me, I have Sebastian Mazza. Sebastian is the principal advisor at the Wealth Depot. Personally, I'm licensed to give advice on self-managed super funds, but I prefer to work with Sebastian because self-managed super funds are one of his specialties. This is one of the things he does best, and for that reason, I prefer to work with people such as Sebastian. And Sebastian, thank you so much for being with us today.
Well, thank you, Michael, for having me join you today to discuss all things self-managed super funds. As you said in your intro there, it is definitely becoming a bit of a new hope for those that want to take better control and be more engaged with their retirement savings. And as you said, the ability for self-managed super funds to own direct property, be it a residential property or a commercial property, have made them very appealing over the last few years. And when they introduced the ability for self-managed super funds to borrow back in 2007, obviously there's been massive significant increase in their appeal for those that, be it self-employed, be it around wanting to ensure that within their retirement plan there was an element of property. And like you said, us as Aussies love property because it's tangible. We get it, we understand it. So here we are.
Yeah, and if we could sort of start off just talking about what is a self-managed super fund, I guess.
Sure.
Because I guess, again, clients will come to me and they'll say to me, "Oh, I heard I can set up buy a house with my super."
Yeah.
And I'll be like, okay, let's start from the beginning, And if you sort of just give everyone a bit of a breakdown, especially to those that have never heard of a self-managed super fund, as to
of course
what they are, how they work.
All right. So a self-managed super fund is a superannuation fund like every other, okay? But it has its own particular rules. It's allowed to do certain things that industry or retail funds aren't able to do, such as buy direct property. A self-managed super fund requires an element of trustee and a member relationship. So clients will see themselves pretty much being in the same, being those dual roles. So a super fund is basically a trust. The assets are held in trust for the benefit of the members at retirement, and the trust is managed by the trustees on behalf of the members. So it's a custodial sort of relationship. The trustee powers and their obligations and responsibilities are significant and are definitely nothing to be sniffed at. ASIC, ATO are very much on the lookout for those trustees that aren't really abiding by the laws and the regulations that surround superannuation in general. So a self-managed fund allows members to have direct control of their retirement savings, to put in place a tailored investment strategy that aligns to their risk profile, their objectives, and so forth. So in essence, industry super funds, retail super funds, and self-managed super funds can essentially do the same thing, but self-managed funds have their own governing rules that allow them to potentially do those little bit extra things like buy property or invest in related entities, and so forth. So far more flexibility around that investment strategy piece.
Yeah, and you can have more than one member.
Absolutely.
Self-managed.
So currently, self-managed funds can have 4 members, but there is legislation sitting in Parliament at the moment to increase that to 6 members. So And members don't have to be related either. They can be unrelated. It's not necessarily the way we like to probably set up super funds, just to that additional layers of risk and governance that need to be considered, exit strategies and so forth. But self-managed funds, yeah, can be set up, between siblings, work colleagues, business partners, or obviously, your immediate family, so your wife, your children.
Yeah, and I guess as a financial advisor, our responsibility is to make sure that a self-managed super fund is appropriate to someone's circumstance, and we've got a checklist of like, I
Absolutely,
don't know, I think
absolutely.
there's like 100 things for us to tick off. But if you could just explain a couple of the main requirements that
Well,
are probably, you could say, at the top of the list,
top
I
of the
guess,
list,
of
yeah.
the 100 things that we need to check off.
Yeah, you're right there, Michael. I mean, it's hugely compliant area. The regulators, have their eye on the sector of superannuation, closely, because unfortunately there's there's opportunities, there's also loopholes, and people try and push those barriers. So when we're sitting with clients and obviously considering whether a self-managed super fund is appropriate, we're looking at things like initial account balances. We're looking for, ideally, for account balances, say, over 250,000, because at that point there's a sort of a crossover between the fees that it is required to set up a fund and to manage a fund, and they sort of commensurate with industry super funds and retail funds. So we're looking at that sort of starting balance. We're looking for the trustees and the members per se to have some conviction around why they want a self-managed super fund. If you're just going to mirror exactly what you have in a current industry fund, then there's doesn't seem to be a lot of reason to do that. There's literally, it requires a lot more attention, a lot more hours spent on the compliance side of things. Thus, maybe the idea of having a self-managed fund might be romantic, but the actual running of it, and ensuring that you stay up to date with your financial reporting and investment strategy reviews, and so forth, that it becomes a bit of a burden. We're looking for things around age of the members, in terms of a self-managed fund for someone probably as a pre-retiree or retiree is a great vehicle to be using. For accumulators, it's not that it's not a great vehicle, it's that, again, it's the time and process that it takes. So we're looking always to make sure our clients understand what is it they're about to embark on.
It is a responsibility, I guess, because if somebody in their 20s or
Yeah,
30s sets a self-managed super fund up, that's, in a way, that's at least 2, 3, if not more decades that they need to be able to, in a way, commit to managing
that's
that
right.
self-managed super
That's
fund.
correct. So it's not a set and forget type of structure. Say, for example, like a trust might be, a family trust, where
Yeah.
you set up, got your deed, and then away you go. Self-managed funds require deed to be reviewed generally every 3 years at least, or when there's significant changes to the legislation, or
Yes.
even the actual construct of the super fund itself. Obviously, the laws are changing, annually. We were lucky this year in the budget that self-managed super funds were sort of left alone. There were some
Yeah, I was surprised
Yeah,
actually
there were
for
some
once.
tinkering with super generally, but self-managed funds were left alone. But you know, we saw back in 2017 a whole raft of reforms come through, and it did actually change, the landscape, quite significantly back then. We're looking for what else we're looking for. We're looking for having a clear investment strategy. So that's where we want to ensure that you just don't go from a diversified, well-structured portfolio of assets, say, being run out of an industry fund, to then sitting in cash in your super fund
Mm,
because you
mm,
you're undecided what you want to do. That's definitely a bit of a red flag. We want clients to have that conviction, that engagement around, okay, yeah, I want to do this because I have these objectives, or I feel that
yes.
in the investment climate and economic climate that we're experiencing at the moment, that I would like to see my assets, my retirement assets, invested in this asset class, or these asset classes.
And what type of assets can super actually be invested in?
So generally, anything that you can think of. We've got the standard property, direct securities or shares, both domestic and global. You've got your bond markets, your corporate securities. But then it's where self-managed funds can actually diversify a lot. They can actually look at things like collectibles, antiques. Like I said, you can invest in startup businesses. You can invest in related entities. So that's where maybe if you're self-employed, a self-managed fund can invest a restricted amount of capital to your business. Obviously, direct property, so holding a residential property or a commercial property. It can also be involved in.
And on that note as well, sorry to
That's fine.
on that note with regards to property, a
Yes.
question I get asked a lot is, can I, buy property and
hmm
live in it or rent it out to my cousin, for example?
The short answer is no. Self-managed funds are restricted in law to buying residential property from what we call related parties. So that could be the member itself, or the member's partner, the member's extended family, and thus, the answer is a resounding no. It does seem a little bit counterproductive, because sometimes clients can hold great residential property, and by transferring that property to a self-managed super fund, obviously they can even potentially improve their retirement savings, through better yield, and obviously superannuation as a tax construct pays tax at a lower rate than the marginal tax rate and corporate tax rate. Um,
Yes.
Thus, it does seem a little bit weird, I guess, for the average punter, that why can't we transfer a great property into a self-managed fund? But I guess it's all these laws are being put in place to protect those that need it most,
Yes.
and thus from unscrupulous sort of property developers and so forth that are trying to prey on the I guess the less informed. Um,
Yes.
Definitely, a self-managed fund can buy a residential property from a third party. It can also buy a residential property in very from a related party in certain circumstance. If that residential property, right, is wholly and exclusively used for business purposes, then it's what we call business real property. And a
Mm.
self-managed fund can then buy that property from a related party. Okay, but it does take a particular set of circumstance, and obviously a lot of analysis around the compliance to ensure that is the case.
Yes.
But with commercial property, so business real property, yeah, a business owner who's looking to either buy a property to provide greater security around their business, better asset protection. A self-managed fund can be a great vehicle to be using in that respect.
These podcasts have been brought to you by Better Financial Planning Australia. To book a free 15-minute phone chat, visit betterfinancialplanning.com.au. And also, just before we get into some of the things to be aware of, and some of the responsibilities of having an SMSF, if
Yes.
we can sort of
Yeah.
touch on, I guess, the advantages.
Okay.
To me, the main advantage is probably the fact that you have more control
Yes.
over where your super's invested. Even though you can with a lot of standard, retail super funds, but SMSF sort of gives you that next level of control, like what you said, collectibles, property, etc. But if we
That's
could
right.
sort of touch on a few of the other advantages, because you did mention asset protection there as well.
Yeah. So for our self-employed or in business owners, that's asset protection is very high on the list of desires. Traditionally, that might be placing business assets and property in separate structures to the trading entity, thus creating a separation there. Self-managed funds, or the assets of self-managed funds, basically cannot be attacked by creditors, such as if the same property was held outside. Thus, it becomes creates this great barrier that allows self-employed persons to have a bit more confidence in their everyday going about in their business. So that's a big advantage. One of asset
Mm.
protection. Other big advantages include things around cash flow and taxation. So when you pay a contribution into a industry fund or retail fund, the minute that money lands into that account, that trustee has already basically swiped your account of the 15% contributions tax or income tax that super funds pay at 15%.
Yep.
Inside a self-managed fund, that liquidity can stay, I guess, in the control of the trustee until such time as when the actual financial and tax return is actually due for lodgement. Thus, trustees have a bit more liquidity to play with, and sometimes that can be quite a big advantage depending on the investment strategy that's being played out inside the fund.
Yes.
Um, we've got things around contribution planning and pension withdrawals in general. So contributions, they can be done potentially lump sum at the end of the financial year, and because it's going from, say, someone's personal bank account over to their self-managed fund, we sort of we're relieved a little bit of those sort of the timing. Like sometimes with the industry funds, they're asking for contributions to be paid a week or even more sometimes, before the end of the financial year. So there's a bit more flexibility around that. Self-managed funds can accept things like promissory notes as contributions. So it creates, again, another whole raft of ideas and strategies around getting funds cash into the funds. From a pension point of view, there's a bit more flexibility around that. You're not sort of, the minimums and so forth and maximums if you're paying a transition to retirement income stream. There's a bit more flexibility around when those withdrawals can be made. Generally, self-managed fund within its governing rules, so its deed provides more options, I guess, around when those payments need to be made. It could be annually, it could be monthly. It's sort of a bit more open-ended. So again, creates a bit more flexibility around those things.
Okay, so I guess the main message is probably control
It
and
is.
estate planning, as you said.
Estate planning, another
asset
big one.
protection,
Yep.
and the tax side of things as
Yep.
well.
Exactly.
Yeah, but I guess the more and more we talk about SMSF, the more the message that I explain to clients, and that you obviously explain to clients all the time, resonates, which is the fact that everyone's circumstance is completely different, and that's where it helps to get proper financial advice, or even
Correct.
just to have a 15-minute chat, just about these things, or even. I mean, to be honest with you, probably listening to this episode would probably be enough in some ways, but it is better to get that one-on-one, interaction to get an idea as to whether it suits someone's situation. Because like what you said, I guess it depends on what that person's trying to achieve and what their goals are.
That's right. Obviously, setting up a self-managed fund does require, because superannuation is a financial product. Self-managed funds come under that regime of those that are, I guess, promoting or advising on self-managed super funds that need to be licensed. Thus, as financial advisors, we have that capacity to provide that advice. Obviously, real estate agents, mortgage brokers, accountants per se may not have the correct licensing to be obviously provide that advice. So it's important that clients do sit in front of a licensed advisor to really understand what's going to be in their best interest, and also free from conflicts of interest. So probably listening to the podcast today, or jumping on the ATO website, they have some great material available around setting up the super funds, what it really entails, the obligations and responsibilities. But getting that initial advice around, okay, well, could this be something that we can consider and appropriate for us? And then if you move past that point, is then getting that correct advice. So we then do the advice around exactly matching your goals and objectives to the strategy, making sure that on replacing your superannuation accounts, that's done in a carefully and considered manner. So there's things like life insurance to consider, estate planning to consider, and the actual investment strategy. So it does take a fair bit of investment up front when you're setting up a self-managed fund. So definitely going into it thinking you can just set it up on the whim or without investing your time and also money to ensure that the structure is correctly established, and that you're getting that proper advice.
So really, don't take the advice of your mate Jeff
No.
that told you about an SMSF on the weekend at a barbecue, basically.
No, exactly. For Jeff, it might be appropriate, and he might have received the correct advice. And
That's it.
And because he now feels empowered and far more engaged in the process, he might feel that he's got the capacity to also talk about it, which is great. But definitely, if you're looking at setting a self-managed fund up, please get in contact with Michael or myself, and we'll make sure that you're on the right journey.
Yeah, definitely. And I wanted to touch on the responsibilities of having an SMSF. And I guess some of the risks in a way, just to sort of, again, not to be all doom and gloom about an SMSF, but just to sort of make people aware of,
that's right.
I guess, some of the risks and responsibilities that come with having one, even though you did touch on some of them earlier.
So like I did mention, a self-managed fund is not a set and forget type of structure. It requires annual and ongoing management. So annually, the trustees are responsible for preparing and auditing the financial statements of the fund, preparing the tax return and lodging the tax return within the required lodgement dates. fail to do those things, which are pretty much, SMSF 101, can see the fund lose its registration and become non-complying. And there's massive tax penalties around that, and just general penalties. Okay, and if there are individual trustees, those individual trustees are penalised severally. Okay, so they each could receive a fine up to $13,000, so up to $26,000 if you have two members or two individual trustees. In that regard, we always like to see our self-managed fund set up with a corporate trustee. Not to get into the the sort of nitty-gritty of it, but yeah, having the correct structure in place protects our clients from unfortunate mishaps potentially.
Yeah, and I guess that's a big part of getting advice as well,
That's right.
because we've both, I'm sure, I don't know about yourself, but
Yeah.
I've come across a few SMSFs in the past that were just set up just not good. Like they could have been done so much better.
Yeah. And generally, they will be set up with individual trustees to reduce the initial cost up front. But most likely the clients weren't aware of the alternative, which is a corporate trustee, or to understand really the differences between the two. Okay. All right. So that's sort of,
Or having a badly worded trust deed as well.
That's right. A deed that maybe has not the same investment strategy capacities. Yeah. So we're looking at things like the reporting function. We're looking at also trustees must review, and I guess the ATO's point of view is regularly prepare an investment strategy that looks forward, that looks so the trustees are taking that time to look at, okay, where are we currently at, and where do we see things in 12 months' time, and to make documented decisions around how they see the members' funds being invested. Okay, industry super funds, retail super funds, do this day in, day out. It's part of their role. As trustees of a self-managed super fund, they have the same responsibility to the members. So, an annually produced and considered investment strategy where life insurance and estate planning should be considered as well. Doesn't mean that you need to have life insurance, but it needs to be considered and documented as to the reasons why or why not it actually wasn't put in place. So that's another big one. Like I said, updating the deed. When you actually set up a self-managed super fund, the HO require trustees to sign basically a declaration that they understand their obligations, that they understand their responsibilities, that they understand that they need to keep their deed aligned to the legislation. We see a lot of old deeds that were set up 10, 12, 20 years ago that have never been updated. That is basically in contradiction to a trustee's obligations, because over that 20 years, laws have changed, and quite considerably, like I mentioned back in 2017. Thus, failure to keep your deed up to date, is another contravention of the rules. So even little things like that, that's where the risks are.
And a few of the other ones that come to mind as well to me is when someone, for example, does set up a self-managed super fund, and let's say their returns are 3% a year. There's that opportunity cost if they potentially could have left it in a different fund that could have potentially been getting them an extra 1, 2, 3, if not more % per year.
That's correct. So that's where you need that. There needs to be some
and
real
that's
conviction.
Where that proper advice comes
exactly
through.
Around that investment strategy and understanding the opportunity costs. Obviously the risks. So we're talking about market risk and liquidity risk around, if we just say buying. Okay, we've got someone that wants to buy a property. They're going to use a lot of their funds to potentially, put down to the deposit, and if they need to borrow, borrow to actually purchase that property. That property most likely will be a significant asset of the fund. So things around liquidity and concentration risk and all those type of things, and market risk generally in the property game, need to be considered. And all that means is that you need to have Plan A and Plan B available and ready to go.
That's it.
All right.
And advice, because
exactly.
Yeah, because I guess I've seen some of the SMSFs I've seen over the years that have been set up with poor advice, or I would say with advice, probably with no advice sometimes. Sometimes someone's literally just asked their accountant to set it up for them and
That's
they
right.
did it.
Yeah.
I don't think that would happen in today's climate, but it's happened in the past, I'm
Yes.
sure. It would be set up with no proper strategy from an advisor. And the issue with that is literally what you just said, liquidity risk, where, because when we put advice together, we show clients projections.
That's right.
We look at over the next, 1, 2, 3 decades sometimes if we have to, just to sort of make sure that there's always going to be enough money there and that the fund will always be able to function and that it's going to serve the needs of the client, the person setting it up.
So we're looking at looking around that, just around that. We're looking at what has been, the member's contribution history, and around, what's their current circumstance. Are they in a stable, secure job? How's their business going? Especially if we're doing things like using a borrowing strategy inside your super fund, these things become even more heightened, because should you lose your job or the business fail, how's that fund going to be able to actually provide repayments on the loan? Thus, the whole strategy could just fall apart very quickly. Even other things like personal circumstance around relationship breakdowns and so forth, or when a member loses incapacity. These things need to be considered up front, not on the fly. That's why you do get advice, because we do bring these things to the fore. We have a chat about these things. We document, what the plan may be. Thus creates a bit more clarity, a lot more confidence, and a bit of a plan, action plan should things not go to plan A. Having a self-managed fund, you do the gravity of the responsibility and the risks obviously are there. You don't have any access to compensation schemes. So if something goes awry, it is the trustee that is personally liable. Obviously not to put advisors into the hot water, but if advice that's been provided is negligent, then that's really the only recourse, and that's obviously a lot of legal action there, a lot of court process, and a lot of time and obviously emotional investment in that journey. So it's important that trustees and members understand that you don't have the same protections, that you are making decisions for yourself, hopefully with guidance from your advisor that's going to look at things holistically for you, and that there is always a plan B in place that provides that confidence that this particular plan is going to work out.
That's it. And I think, just in summary, I think a lot of what we've spoken about really just enforces the fact that if you get proper advice and if you get good advice, and a self-managed super fund can really suit someone's circumstance, and it can actually, it's a tool, it's a vehicle that can be really used to its full advantage, and that everyone's situation is different, as I've said numerous times, in that getting that advice can really, really make sure that an SMSF actually works for someone and that they get the full benefit of it. Thank you so much for your time, Sebastian. I really appreciate it. I know that this episode would clear up a lot of the questions that I get asked a lot, and I'm sure you get asked a lot as well. One last thing, do you want to finish off with any final points before we close off?
I think just to, again, reiterate that get good advice. There is plenty of help out there and guidance. Take your time to carefully consider whether a self-managed fund is correct for you. And the day is that, like you said, Michael, it is an amazing vehicle to help grow and nurture your retirement savings. I'm definitely a 100% believer in self-managed funds. And like I said, they might not be right for everybody, but if there's the right circumstance, then check it out.
Beautiful. And just to finish off with a dad joke, over all my episodes, this wouldn't be a Sharing More Than the Sheets episode without a dad joke right at the end. A termite walks into a bar and asks, "Is the bartender here?"
They keep getting better and better, mate.
I know I've got so many here, but I'm just trying to save them. It's okay.
Yeah, you're building them up.
Building them up. Thank you so much for your time again,
Michael.
Sebastian.
Thank you. I appreciate the opportunity, and we'll talk soon.
Thanks for joining us on Sharing More Than the Sheets. Please make sure you subscribe to be updated with future episode releases. Please visit us at sharingmorethanthesheets.com.au to submit questions or requests for future podcast topics. These podcasts have been brought to you by Better Financial Planning Australia. To book a 15-minute phone chat, visit betterfinancialplanning.com.au.